Well, banks do in-market mergers for a variety of reasons, but typically it arises from the bank's own strategic planning process. Some banks choose to expand across various geographies and diversify their businesses that way. Others simply focus on a single metropolitan statistical area, or MSA, and they choose to concentrate their efforts and aim their efforts at the customers within that market. So those are the banks that typically are most interested in doing an in-market merger. It gives them access to products, customers, and people that perhaps they don't have at their bank, and it allows them to diversify within their home market. But as a rule, as we look at mergers over the last 5 years, we haven't seen a lot of these in-market mergers take place. They're only about 20% of mergers over the last 5 years take place within the same metropolitan statistical areas. So while they can be very beneficial to both buyer and seller, they don't typically happen with great frequency or magnitude. Well, there's a variety of things that banks need to consider before embarking on an in-market merger. The most significant one in my mind is the regulatory aspect of this, because the federal banking agencies and the Department of Justice have specific regulations that relate to market concentration. So if two fairly sizable banks within an MSA are going to combine, it could create a market concentration issue that results in the deal not getting approved. So the bank and its advisors need to do a preliminary screen and make sure that that's not the case. The second is culture incompatibility. If the two banks have incompatible cultures, the merger is not going to be successful, whether it's in market or out of market. If after closing we see a significant number of customer-facing personnel who depart the bank because they can't get along with the new management, that creates a significant economic issue for the acquiring institution, and they have to take these things into consideration before they propose to merge. There are several drawbacks banks need to consider when contemplating an in-market merger. One of these, obviously, is reputational risk. We talked about cost savings and how those can be enhanced through an in-market merger. And with that comes a significant opportunity to harm the bank's reputation because of a couple of reasons. One is branch consolidation. If there's a branch that a customer's been going to for 20 years in a given market, and now they have to go down the street, that can create some friction that may result in the loss of that customer. So that's an issue. There's a second issue there related to employees. If there is significant cost savings and elimination of overlap between the two banks, that results in significant layoffs within a concentrated community. And that can harm the reputation of the combined bank going forward. And the third issue that banks need to consider really is the regulatory situation and making sure that the merger is in accordance with the guidelines set forth by the federal regulatory agencies on concentration. These risks are not insurmountable, and banks routinely deal with these. But in an in-market situation, these risks are amplified, and we need to make sure that we have a plan to mitigate those before we announce the transaction.